Good day, everyone. We are Group 4 and we are going to report valuation methods, fair value accounting, and financial reporting standards. I am Irene Arong, one of the reporters, and together with me are Carla Fatima Far, Dana Julian Ibo, and Marilo Mendoza.
For today, we will discuss the following contents. First, definition of fair value. Second, framework for measurement requirements of fair value under IFRS 13. Third, valuation techniques. Fourth, valuation inputs. And last but not the least, fair value hierarchy. There are two definitions of fair value that I will be introducing today. First, prior to the introduction of IFRS 13 in May 2011 by the IASB, the definition of fair value was referenced as the amount for which an asset could be exchanged or a liability settled between knowledgeable and willing parties in an arm's length transaction. This definition of fair value is similar to that of fair market value as commonly adopted by valuers in conducting business valuation. However, such definitions have been criticized as follows: they do not determine if an entity is buying or selling the asset, they do not explain why a liability is settled to knowledgeable, willing parties instead of creditors, and they do not determine which date the exchange or settlement takes place. Here comes the second definition. To address those points, the IASB revised the fair value in IFRS 13 as the price that could be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This definition emphasizes that fair value is an exit price and not an entry price. Exit price or fair value is the price that the entity will receive when selling an asset or pay when transferring a liability, whereas the entry price or transaction price is the price that the entity pays to acquire the asset or receives to assume the liability at the measurement date, which is also known as the valuation date. It is observed in many situations that exit price and entry price may be identical. That's why the standard further describes certain circumstances and conditions in a transaction that may lead to the difference between the transaction price or the entry price and the fair value or the exit price of an asset or a liability. The transaction is between related parties unless there is an evidence that the transaction was into at the market terms. It is a forced transaction or distress sale. For example, the seller was experiencing financial difficulty and would be willing to sell the asset at a price below the market price to get quick cash. The unit of account represented the transaction price is different from the unit of account for the asset or liability measured at fair value. For example, when an entity purchased a block of 10 units of property, their transaction price might already include a blockage discount and hence the transaction price per unit of property might not represent the fair value for each acquired property unit, or the transaction takes place in a market that is different from the principal market or the most advantageous market. An example is when a trading and wholesale entity entered into transactions with customers in the retail market, but the principal, or the most advantageous market, for the exit transaction is with other traders and retailers in the wholesale market. Another important point to note is that the transaction, for instance, the selling an asset or transferring a liability, for the determination of fair value would be orderly and therefore is not forced transaction or distress sale. Finally, fair value is a market-based measurement and not an entity-specific measurement, and therefore is determined based on assumptions market participants would consider in pricing an asset or a liability. The key components of the fair value measurement framework can be summarized as shown in your screen. First, a valuer has to identify the characteristics of the subject, asset, or liability. In particular, if the asset is non-financial, The valuer has to identify its highest and best use not from the entity's perspective but from the market participant's perspective. Second, the valuer has to identify the principal market or most advantageous market in which the subject of valuation is normally traded in an orderly transaction and more importantly, whether the reporting entity can gain access to such markets. Third, the valuer has to identify the characteristics of the market players, example the buyers and sellers, who are able and willing to transact the subject of valuation in the principal or most advantageous market. Fourth, the valuer has to determine the appropriate valuation technique for the valuation of the subject asset or liability. The valuation technique should take into account considerations and assumptions which market participants, in view of their best economic interest, normally use for pricing the subject of valuation. In addition, the valuation technique also maximizes the use of observable inputs and minimizes the use of unobservable inputs. Fifth, the valuation inputs are categorized in a fair value hierarchy which gives more priority to observable inputs and less priority to unobservable inputs. In addition, the valuer has to consider the valuation inputs, including premiums and discounts, that consistently reflect the characteristics of the valuation subject. The valuer must also consider other assumptions, such as risk premiums, which account for the uncertainty of cash flows arising from the valuation subject that market participants will take into account for pricing purposes. And finally, the valuer performs a valuation of the subject asset or liability based on the valuation techniques and inputs which are analyzed and selected from the previous steps. Valuation techniques and inputs used, especially the significant unobservable inputs and effects of the measurement on financial results, are required to be disclosed in the financial statements of the reporting entity. If you want to get details of what I just said in the previous slide, just go through this table for study purposes. And now we will now discuss briefly the key concepts of the fair value measurement framework. As mentioned in the previous slides, one of the key components of the valuation process is understanding the subject of valuation in business. It is important for the reporting entity or valuer to consider the characteristics of the valuation subjects, and such characteristics should particularly be taken into account by market participants when pricing the valuation subject. Some of the characteristics can include the following: location and condition of an asset. If the asset is not in the location or condition that market participants would require for its sale at an observable market price, then a valuer would need to adjust the price for which a market participant would pay for the asset in its current condition and location. Second, restrictions, if, a- if any, on the sale or use of an asset or transfer of a liability. If a restriction is transferred with the asset in a sale transaction, it would be deemed a characteristic of the asset and therefore will likely be taken into account by market participants in their pricing of the subject asset. On the other hand, if a restriction is only specific to the entity that holds the asset and is not transferred with the asset in a sale transaction, such restriction will not be considered in assessing the value of the subject asset.
Highest and best use for non-financial asset. In valuing a non-financial asset, a valuer is required by the accounting standards to consider the context in which such an asset can generate benefits that represent its highest and best use. Highest and best use is determined from the perspective of market participants, even if the entity holding the subject asset intends to have a different use. So, for example, an entity owns land located nearby universities, like for example near USC and CNU, and presently leases it out as a parking lot for surrounding establishments. From the market participants' perspective, the land will generate the most economic benefit if it is used for the development of an apartment or condo unit for students. This means the use for the development of an apartment or condo unit is the highest and best use of this asset. Therefore, the valuer should value this asset on the premise that it will be developed into an apartment or condo instead of a parking lot. When determining the highest and best use of a non-financial asset, a valuer should consider the following. First, a use that is physically possible. A valuer will take into account the physical characteristics of the asset that market participants would consider when pricing the asset, such as the location or the size of the asset. Second, a use that is legally permissible. A valuer will take into account any legal restrictions on the use of the asset that market participants would consider when pricing the asset, such as local authority regulations. And third, a use that is financially feasible. A valuer will take into account whether a use generates adequate income or cash flows, considering the cost of converting the asset to that use, to produce a return that market participants would expect. Finally, the highest and best use of a non-financial asset can be assessed on a standalone basis or as part of a group in combination with other complementary assets and or liabilities. Principal or most advantageous market. The principal market is the market with the greatest volume and level of activity for the subject asset or subject liability, not based on the entity's activity in a certain market. Normally, it is the market where the entity usually runs its business activities or transacts its products. Example number 1, principal market. Company A can only sell product B in markets X and Y, whereas market participants can sell product B in markets X, Y, and Z. The allocation of the total sales volume for product B transacted in the three markets X, Y, and Z are summarized in Table 1. So, as shown in Table 1, market Z has the greatest volume and level of activity for product B. However, Company A does not have access to market Z, and therefore market Z cannot be the principal market for product B from Company A's perspective. Company A has 70% of its sales volume in market X as compared to 30% in market Y. From the whole market perspective, the sales volume for product B in market X is also higher than that in market Y. Therefore, market X will be considered as the principal market for product B. IFRS 13 also introduces the concept of the most advantageous market in the case where the principal market cannot be identified. It is the market after taking into account transaction costs and transport costs that maximizes the which would be received to sell the asset or minimizes the amount which would be paid to transfer the liability. Basically, the market that would yield the higher price for the assets after deducting transaction cost and transportation cost is the most advantageous market. For example, number 2, most advantageous market. Company A can sell product B equally in markets X and Y, and neither market can be clearly identified as the principal market. Selling prices and relevant costs for product in each market are summarized in Table 2. So as shown in Table 2, Company A can generate net proceeds of $7 for product B in market Y as compared to that of $6 when it sells product B in market X. Therefore, market Y will be the most advantageous market for product B. So, under IFRS 13, the fair value measurement is based on a hypothetical transaction that will take place in the principal or most advantageous market as the time measurement date under present market conditions. As such, a transaction will be orderly in nature. So, market participants. Market participants are buyers and sellers in the principal or most advantageous market for the asset or liability. When performing fair value measurement, a valuer is required to use the assumptions that market participants acting in their economic best interest would use when pricing the asset or liability. An entity does not need to identify specific market participants, but instead, they should identify characteristics of market participants that would generally transact for the asset or liability being measured. So, in determining the characteristics of the market participants, a valuer should consider the following. First, factors that are specific to the subject asset or liability. Second, principal or most advantageous market for the subject asset or liability. And third, market participants that would transact with the reporting entity in that market. So, the principal market or most advantageous market is determined from the perspective of the reporting entity, and therefore, other entities operating in the same industry as a reporting entity are most likely to be considered as market participants. However, market participants can be outside of the reporting entity's industry when assessing the fair value of an asset on a standalone basis. In addition, IFRS 13 also highlights the following key characteristics of market participants when presenting the definition. First, market participants are independent of each other. This means they are not related parties as defined in IAS 24 related party disclosures. Second, market participants are presumed to be knowledgeable, having a reasonable understanding of the asset or liability, using all available information, including that obtained through market participants' effort. And last, market participants are able and willing to enter into a transaction for the asset or liability.
The valuation technique. According to IFRS 13, the objective of using a valuation technique is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between the market participant at the measurement date under the current market conditions. The standard recognizes three widely used valuation techniques: the market approach, the cost approach, and the income approach. First, the market approach. It is based on the market transaction involving identical or similar assets or liabilities. It uses prices and other relevant information generated by market transaction involving comparable assets and liabilities or a group of assets and liabilities such as business. Next is the income approach. It is based on the future amounts that are converted or discounted to a single present amount. It converts future amounts to a single current amount that the fair value measurement is determined on the basis of the value indicated by current market expectation about those future amounts. Lastly, the cost approach. It is based on the amount required to replace service capacity of an asset, frequently referred to as current replacement cost. The standard further explains that the form from the expected perspective of the market participant seller, the price that will receive for the asset is based on the cost to a market participant buyer to acquire or construct a substitute asset of comparable utility, adjusted for obsolescence. That is because a market participant buyer would not pay more an asset than the amount for it which it could replace the service capacity of that asset. Obsolescence does not simply mean that depreciation for accounting or tax purposes, but consists of physical deterioration, functional or technological obsolescence, and economic or external obsolescence.
Valuation inputs. In accordance with IFRS 13, inputs to be used in a valuation technique are required to, first, be consistent with the characteristics of the valuation subject that market participants would take into account in a transaction for that valuation subject. Second, exclude other premiums or discounts if they are inconsistent with the unit of account. And third, exclude premiums or discounts that reflect size as a characteristic of the entity's holding as opposed to a characteristic of the item being measured. With regards to the second unit or input, unit of account, as defined by IFRS 13, is the level at which an asset or liability is aggregated or disaggregated in an IFRS for recognition purposes. In practice, if the valuation premise differs from the unit of account, fair value may need to be allocated or adjusted to ensure it is consistent with the unit of account. So, it is required by IFRS 13 that the fair value measurement shall maximize the use of relevant observable inputs and minimize the use of unobservable inputs regardless of the valuation techniques being used. This is consistent with the market-based fair value measurement principle, which uses available and relevant market-based observable data.
The next topic will be fair value hierarchy. This is introduced by the IFRS 13 wherein three levels of inputs are assigned for the valuation techniques used to measure the fair value. Level 1 inputs are observable which are obtained from an active market. According to IASB, this provides the most reliable evidence and should be used when available. These inputs are based on market data. An example would be publicly available information about actual events or transactions. This reflects assumptions that market participants would use when pricing assets or liabilities. Active market is defined as a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. IASB highlighted there are similar assets and liabilities with large numbers in which an entity may not have an available active market. Therefore, entities should instead use an alternative pricing method that does not rely on quoted prices. Level 2 inputs are based on observable market data such as market corroborated inputs, derived principally from observable market data by correlation or quoted prices for identical assets and liabilities in non-active markets. Adjustments with the use of an observable evidence will lead to level 3 inputs. Level 3 inputs are subjective and non-observable. These inputs that have available market data and are only based on the best information available. It is important to remember that although inputs in this level are unobservable, it should reflect the assumptions and considerations that make participants take into consideration when pricing assets or liabilities. The objective is to end up in a fair value that meets the definitions of IFRS 13. The best information may include the entity's own data. The table shown summarizes the determination process of the fair value hierarchy. Premiums and discounts. IFRS 13 permits a premium or discount to be included in a fair value measurement only when it is consistent with the unit account for the item. The premiums and discounts that reflect size as a characteristic of the entity's holding, such as blockage factor, reducing the price which could be achieved on disposal of an entire large equity holding rather than as a characteristic of the asset or liabilities such as the control premium when measuring fair value of a controlling interest are not included. Next, risk premiums. IFRS 13 described risk premium as compensation sought by risk-averse market participants for bearing the uncertainty inherent in the cash flows of an asset or liability. Risk premium is also referred to as risk adjustment, which refers to participants having to consider risk premium of an assets and liabilities when pricing. The higher the risk of an asset, the lower its fair value since market participants would likely pay less for the uncertainty. If uncertainty is accounted for in the discount rate, it will result on upward adjustment to the discount rate in the valuation of assets. That would be all. Thank you for listening.